What's up guys, Kanal here from Level Traders. In today's video, we'll bring you everything you need to know about moving averages. We hope by the end of this video, every viewer understands how to use moving averages to identify trends, what the most popular moving averages are used by traders, the difference between simple moving average and exponential moving average, and how to trade a breakout of a moving average. But before we go into that, let's have a look at what a moving average is. Check this one out. So let's start with the definition. What do we mean by moving average? Moving average is an ongoing mean average of price over a specific period of time in the past. The purpose of a moving average is to smooth out the price data to give a constantly updated average price. This in itself can help identify trends in prices. So for example, if we look at the chart here, we've got Netflix. If I take the 40-day moving average, so that's the green dotted line. So firstly, the 40-day moving average, what is that representing? That represents an average of the prior 40 days price. That's what that represents. And that constantly gets updated every day as price moves. Now, just using that moving average alone, so the green line, if I comment on the chart in front of us, what we have is almost a two-wave uptrend. We've had a two-cycle uptrend. So you've got Netflix trending upwards in a two-wave period where it's had a bit of a sideways movement where the line is flat. So that's where you can see a two-wave movement upwards with a flat consolidation period. So straight away, moving averages helps describe, not just describe, but also help what the overall trend in the market is. So one of the benefits of using moving averages is it helps identify trends. So traders can get a view on a market or asset for trading. On the flip side, one of the limitations of using moving averages is that it looks at past prices. So the moving average itself is a lagging indicator, and that's something to be wary of. So let's have a look at the most popular moving averages that traders use. So here we have, in black, we've got the 8-day moving average. We've got the 20-day, 40-day, the 50 days a popular one. We've got the 55-day moving average, the 100-day, and the 200-day, which is widely used by not just traders, but it's also it's something that gets reported in the media quite a bit, the 200-day as well. So you can see it gets quite busy in terms of if you try to use all 7. So my recommendation would be to use no more than 3 or 4 moving averages on a chart. I typically use, I pick one long term, I pick one short term, so I tend to go with the 200-day. For the short term, I'll either pick the 8 or the 20-day, and I'll pick 1 or 2 in between, so the 50 or the 55-day moving average. Also notice how the, as we spoke before, how the moving average compares to the actual price. You can see there's a bit of a lag, right? So if you look at the fall we had in September, so this is the S&P 500 chart I'm using. It's the daily chart, and what you can see here is the big sell-off we had in September. The price fell sharply. If you look at the moving averages, the turning points are after the event. So that's one thing we said you have to be careful of, that the moving average will always follow the actual price. So even if we look at another example, just around November, you see the price bottom there in the S&P, but the moving average didn't really turn up. So until early November, the actual bottom was just before or start of November, whereas you can see the actual moving average started to turn up probably in the first week of November. And that's just the 8-day. Obviously, the longer the time horizon, the later that moving point will be. So if you take the 200-day, that'll take even longer for that to be reflected, because it's looking at a longer average of prices. So one of the common questions around moving averages or debates is, what's better to use? The simple moving average, the SMA, or the exponential moving average, the EMA? So let's have a look at the two in practice. So the first common thing is they both do the same thing. They both measure trends. They both smooth out the price over a given period of time. That's a given because they're moving averages. The key difference is the simple moving average applies an equal weight to all values. The exponential moving average applies a higher weighting to recent prices. So what does that actually mean in practice? So simple moving average, if we take the 8-day, for example, the 8-day moving average, the way to calculate that is it'll take the price of the preceding 8 days and calculate that by the number of days, so by 8. That will just give you the arithmetic mean average. That's the simple moving average. What the EMA will do, it will give more weight to current data, so the newest price will impact the moving average more, with older price having a lesser impact. Now, what does that mean? So, what that means is EMA will be more reactive to recent data than older data. So it's going to react more to latest price changes than SMAs are. So the way I look at this is you've got the classic example of the hare and the tortoise. So the tortoise in this example is the SMA. It moves more slowly, whereas the hare will move more quickly. So that's the EMA. So if there's one thing, guys, if there's one thing you should take away from this video, it's that. It's the fact that the EMA is more reactive. It's quicker to reflect the price action versus the SMA. So going back to the question, which one's better to use, or which one's more likely to give you a better result for trading? Well, the answer to that is it really depends on what type of trader you are. If you're a short-term trader looking to trade kind of intraday or day trade, the EMA will be a better suit for you because it's going to be more reactive than the SMA. The SMA will take longer. Whereas if you're more of an investor or you've got a longer time horizon, I think the SMA is also fine. One thing to bear in mind, because the EMA reacts a lot to price, you can also see fake outs. So a fake out is where a price looks like it's broken a certain area, so that you've got a break in price, but it reverses, so it's a false break. Now that happens a lot with EMA because it's reflecting current price more, whereas the SMA is lagging even more than the EMA, so it's smoother. It's not as reactive. So that's one thing to bear in mind. So to illustrate that point further, let's have a look at an example of it on the chart. So here I've got Amazon. It's a daily chart we're looking at, and it contains the 20-day moving average. I'm using the simple moving average in black and the exponential moving average in blue. And you can see the subtle difference in the two, right? Now, one thing you can see is the SMA, the turning points are just slightly before the EMA. So that reiterates the point that the EMA reacts more quickly to price changes because of the higher weight it's given to recent prices. So if you're a short-term trader looking for turning points, EMA might be the better one to use than SMA. This chart as an example, if we look at the, let's have a look at one of the turning points. So if you look at the sell-off in September here, you can see the EMA peak is bang on September, whereas the SMA peak is around 2 weeks later. It's around the 10th of September. So you can see the difference there, and it's the same for the when it bottomed, right? So you've got the price bottoming around mid-September. You've got the bottoming kind of happening just after price on the EMA, whereas the bottom on the SMA is at the start of October. So there's a big lag. There's around a 2-week lag again between when it peaks and the trough. So this is the limitation you have when using SMA in short-term trading. So the final thing we're going to look at is how to trade a breakout of a moving average. Let's take a look. So here I've got a chart It's the social media giant, Facebook. It's the daily chart, and the period we're looking at is March 2020 to November 2020. I've chosen to go with 3 moving averages. I've gone for 1 long term, 1 short term, and 1 medium term. For the short term, I've gone with the exponential moving average because the EMA tends to react quicker to price. Whereas for the longer term, I've gone for the SMA. So a very simple trading strategy here would be, if you take the 2 red circles I've highlighted, all that is focused on is the 200 simple moving average. What it shows is a sell signal where the price is broken below the 200 day, so just around March, and then it's reclaiming the 200 day just before May. So that would be your buy signal to re-enter Facebook. So you could simply do nothing else but use the 200 day, and you can see there's a strategy there. That's probably more for medium to longer term traders. Traders that are looking to scalp or day trade, that's where I've highlighted the orange circles. So that's using more of a shorter term moving average. So we're focusing now on the 20 and the 55 EMAs. And again, you'll see, very simple, you could have bought the stock every time it's tried to break the 20 day. So you had 2 attempts, 2 buys in April, early April and late April, where you've had two attempts at breaking the 20 day. Each time that held, that was a buy signal right there. You could have bought that every time it retested it in that period at the 20 EMA. Obviously, you then get the break above the 200 SMA late April. That was your clear signal to buy. Now, you could have also have done the same strategy around July and August using the 55 EMA. So there was a false break on July 2020 where the EMA held, and you had a similar strategy in August where price came and retested the 55 EMA, bounced back, and you could have bought it there. And then there's a sell signal I've highlighted around mid-September where the price has lost the 20 EMA, and that was a sell signal for price to go down further. So you can see, simply using the moving averages, there are trading strategies just there in front of you. Now, one thing I should say is these are not the only trading opportunities on this chart. This is purely examples I'm highlighting here for illustrative purposes. And the other thing I should note is moving averages are by no means the only tool that should be used when generating trading ideas. However, moving average should certainly help evaluate a trading opportunity. So it should be a part of the process that you go through to evaluate a trading strategy. So that in a nutshell is everything you need to know about moving averages. Hopefully you found this video useful. Thanks again for watching, and remember to subscribe so you don't miss any future videos. Thanks again. Take care, folks.